In the second time in as many weeks, central bankers have raised this looming specter of what's about to happen. And interestingly enough, with the markets going through all of this, nobody is talking about it. Well, we're going to be talking about it coming up. Welcome to ITM Trading. I'm Lynette Zang. And we all know, anybody that's turned on the TV has been seeing, or on the computer has been seeing, the markets roiling. Last week, we talked about a specter. I'm going to show you this. But we do know that the markets are definitely in a bear market. And this is global. The bear market started overseas, and we were supposed to be immune because this time is different. No. This time is clearly not different. And the headlines that we're seeing take us back to other crises. 1980, the Depression, 2008, 2009. For 10 years, the Federal Reserve, the central banks, have had the back of the markets, getting the markets addicted to that liquidity. Are they supporting it now? No. And we saw what happened yesterday when Fed Chair Powell raised the rates 0.25%. It's not the number, though. What I want you to really understand about this is that what is actually happening is the reverse of quantitative easing, that drug that the markets just binged on and created these massive debt levels around, which we're going to talk more about next week. Well, now the punch bowl is being taken away, though that started in 2016. So what we're really seeing is when they raise the rates, and you need to understand the implications globally, the dollar spikes. Why? Because we're now willing to pay more. Our interest rates have gone up, so we're willing to pay more than many others out there. So in theory, that means that entities will be buying a lot of dollars, and the dollar spikes. Is it really gotten a whole lot stronger? Remember, they refer to the strong dollar. That's against other fiat currencies. Your personal experience is a better guide to that. Because if the dollar were really that much stronger, then what you buy every day would be that much cheaper, particularly for imports. And really, think about it. Have your prices gone down? No. But a stronger dollar means that all of those emerging markets, and China's a huge one, that have borrowed in bonds in terms of dollars, stronger dollar means that it costs them more now to service those bonds. And we could even see, because we are in a global bear market, a global slowdown, that means incomes go down, you could see a lot more bankruptcies, a lot more defaults that would impact the global market, pushing us even further over the edge. This is going to be coming up next year. We're going to be talking about it. But the other thing that he did was said that the balance runoff sheet was on autopilot, which means that, and you can see, this is the QE where they were injecting all of this liquidity heroin into the arms of the markets. Now they're taking it out, making it more expensive to borrow, but also they're not in there buying and buying and buying to support those markets. And this, even though we started raising the rates and reducing the balance sheet, remember why they said they needed to do that? It was to give them some firepower for the next crisis. That's why they're doing it. And we're seeing this trend, or at least the attempt of it, on a global basis. But QE was an experiment to begin with, and it gave us lots of asset bubbles. QT, which is quantitative tightening, which is reducing that liquidity, what they're really trying to do, what the Federal Reserve and other central bankers are attempting, is to wean these addicted markets off of that money that they got for free, except that all those debts are going to be turning over, that we're going to be talking about next week. So at any rate, the result of them saying now the balance sheet is going to be on autopilot, which means every month they're just not going to reinvest them. You can see what that looks like. That pushed the yield curve even flatter. So we have it inverted at the 2 to 3 year, 3 to 5 year level, but it's also more flat, the 2 to the 10-year yield. That's not really good. So what is it that the Fed is seeing? And actually the ECB, we talked about it last week because the ECB brought it up. And I'm going to show you that in just 1 second because I go back to my daddy for this. Do what I say and not what I do. What he's saying is that, hey, everything is fine in the economy and the consumer is really strong, except consumer discretionary stocks like building, auto, banks, and retail are all in bear market territory. So the stock market is not telling the same thing that his lips are saying. But this is the real key of this, and nobody else is really talking about it because they don't want to. They lowered their GDP forecast, which means slower growth, which means things are not so great. I don't care what they say. They also turn around and say, yeah, the economy is not growing so hot. Shocker. In addition, they expect wage pressure because of the tight labor market. They expect wages and other costs to go up. Now, we heard Mario Draghi talk about it last week. Now we hear Fed Chair Powell talk about it. That's stagflation. You know the last time that we had to deal with this? And I don't think that this is really, I always talk about repeatable patterns. The last time that we dealt with stagflation in this country was in the 1970s. What was happening in the 1970s? We were transitioning from a gold-backed system to a debt-backed system. What is happening now? We are transitioning from a debt-backed system to, I'm afraid to say it, I think it's going to be, a purchasing-based system. Money will be purchased into existence by people shopping. That's why they've been driving the world to consumerisms. But you get to a level where the consumers can't consume so much when they've taken on debt. We're not really talking about debt today, but I want to bring that up because even though they're saying it, slower growth, higher costs, they haven't actually used the word stagflation. So you hear it here. They're talking about it. We're talking about it. They expect a spike in inflation. And yeah, because there's only one way to fight deflation, and that's with inflation. That's the only way. So they may be cutting back, and you might see Fed chair raise rates and let the balance sheet run off, and maybe the Bank of Japan isn't buying quite as much, or maybe the ECB is trying to cut back. It's not going to last long, because the globe is now in a bear market with the specter of stagflation. How can they get that growth to escalate? The tax law changes, the repatriation didn't do what they thought. Well, maybe it did do what they actually thought, but it didn't do what they told us it was going to do. Shocker. Did the same thing last time. No, it's not going into capital expenditures. It's going into stock buybacks. Debt for corporation has grown 60%, but earnings have grown 27%. Another topic for next week, but can you see how all of these things really do come together? So that's what the central bankers are seeing. They see stagflation, slower growth, higher inflation. Not a good position for anybody, really, to be going in. That would be like your bills keep going up, but your income doesn't keep up with it. Oh, wait, that's pretty typical actually. Now the corporations are going to be squeezed. But the markets see this too. Now, what I'm about to show you, I'm getting goosebumps, okay? We've been talking about this for a while. The first one I'm going to show you is a transportation index. So this is what moves goods around the country and in some cases around the world. And you can see this is where it started the year. So all of these are from the first of the year. This is where it started the year. This is where it peaked in September of this year. There's that death cross. Remember, we've talked about that 50-day moving average. When it crosses below that 200-day moving average, that is actually technically called a death cross. And you can see once it crossed it, look at how rapid the markets imploded. Guess what? That's a keen pattern shift. We saw the same thing right after that with the NASDAQ. We saw, and I'm going to just let you note here that in all cases, the current price is below the January where it opened in January. But I want you to look at the confirmation that we just got yesterday of the Dow theory being confirmed, because the Dow Jones, which is the manufacturing index, just crossed, which means that even as nasty as this looks, it is really frankly likely to get a whole lot more nasty. And if you listen to Main Street media, what they're talking about is the hopium that the pension plans must rebalance their portfolios, and therefore, because the stocks have moved down so much and the bonds have moved up so much, that they're going to have to go in and buy stocks. Well, the greatest buybacks in history haven't been able to support this market. The pension plans are in there helping transfer the risk, as we saw last week, and I've shown you that so many times. I'll show you more into the future. But this is how they transfer the risk. Pension plans, the 401ks, all of that the institutional investor uses other people's money. So while insiders are getting out in droves, and we've been watching that for a very long time, but particularly about a year, 14 months ago is when we started noticing a huge shift in insider selling and this huge spike. They got out near a top. Are you still sitting in there? Just saying. So if the Federal Reserve and the central banks aren't going to help the markets like they were, what about the government? Well, and I'll tell you, by the way, all of these charts were pulled last night, actually, after the close. So on the 19th. These are the 19th. Well, today, it looks like they're not going to pass the stopgap spending bill that would fund the government through midnight on February 8th, which means that if they don't do it by tomorrow night at midnight, there will be a Christmas government shutdown. So the markets aren't really seeming particularly happy about that either. So the markets got what they wanted in the beginning of the year with the tax law changes, and between the tariff war with China and everything that's going on there, which has escalated, and the hard Brexit that we're going to have to be talking about probably next week or the week after. Now we've got this battle in the White House that looks like we're going to be shut down. I mean, I don't know yet because it's not tomorrow night at midnight. So anything can happen. But in all of this turmoil, in all of this negativity, there is a bright spot. Technically, now remember, these are spot silver and spot gold. And these were designed to manage how you think about silver and gold. And they've done a fantastic job. But you've got a nice cup formation, and it looks like on silver, the base is being built. It needs to break above the 15, and then we'll see it most likely go a lot higher. Gold has already done that. There's the gift that keeps on giving. Does not reflect its fundamental value. Only thing that is undervalued in a long-term positive trend. Only thing. I mean, you get to choose where you want to hold your wealth. But obviously, you know, it's frankly, how can I recommend that you go into fiat products? People ask me all the time, well, what else can I do? I don't really want to do that. I've done so much of it. What else can I do? I wish I knew. Honestly, I wish that there was something else that was undervalued and in a long-term positive trend that I could tell you about. But there isn't. It's not. I'm only going to tell you what I'm doing for me. That's all I'm going to tell you. You do whatever you're comfortable with. You don't have to take my word for anything. Follow the links. Do your own due diligence. Come to your own conclusions. But I'll tell you right now, it is a very, 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 very big deal that in 2 weeks you had two central bankers, the ECB and the Federal Reserve, bring up slower growth, higher inflation, stagflation. This is a very, very, very big deal. Mark my words on it. The bear is absolutely here. And because of everything that's being thrown at the markets, my bet is that enough risk has been transferred. Remember, I keep asking that question. Has enough risk been transferred? Because once enough risk has been transferred, and maybe this is the opportunity to transfer. I mean, it'll be interesting to see what the pension plans do. I'm going to be taking a look at that through the ICI once this dust has settled through the end of the year. It'll be interesting to see what they've done. And we could also, by the way, see it on a smaller basis if you go into the NASDAQ. You can just Google it. Insider institutional holdings of whatever stock you're curious about, and it'll show you what they've done for the last 3 months, the last 12 months. So we'll be able to see some of it there as well, but we're going to be taking a look at that. In the meantime, this is the time to make sure that you have plenty of dry powder and that you are in safety. And I go back to my mantra: food, water, energy, security, community, shelter, barterability, wealth preservation. Get it done. Get it done. Get it done. So tomorrow you're going to be, I think we're going to be releasing that tomorrow. Yeah. The interview, boots on the ground, that I did with Hamza in Turkey, who is going through a crisis. So you can get a glimpse of what's coming to a theater near you. It's coming here. It's coming everywhere. This is a global issue. Make no mistake about it. You need to get ready. So that's a really important interview. We're going to be releasing it tomorrow. Next week's, do I have anything next week? Or it's just the holidays, so that kind of makes it a little odd. But I'm telling you, I'm not stopping. I'm not taking any time off. I'm going to be, especially during this critical time as the markets are roiling, I might even start a little something next week we'll just kind of see. I don't want to say anything yet. Let me see how it goes. But we're going to be talking about the leveraged loan market, which is what Janet Yellen just recently warned us about, because it does appear like that has now begun to roll over. I don't want to say anything too much about it yet. Let me do my research. We've talked about leveraged loans before. I'll have Megan put the links to the one that I did recently on leveraged loans in there, so catch up on that, because that's critical. That's critical. We need to look at that. So that's what I'm planning, at least at this point, unless something else comes up. That's what I'm planning on talking about next week. But between now and then, just keep in mind that shields are made of metal, not paper or promises. And please, 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 be safe out there. Bye-bye.